The biggest thing about the market, in my opinion, is liquidity. You have to look at the liquidity numbers that's put out by the Fed. So they calculate this based on numerous metrics. Suffice it to say, anytime that there's a big market crash, there's a drop in liquidity, and this liquidity is public information. You don't need to, go out and look for this information. It's right on the website. So there's a lot of people that are gloom and doom. There's a lot of people that provide fear, whether it's on YouTube or on the news. Everybody keeps talking about how the market is going to crash. But, in my opinion, look at the liquidity. Once the liquidity starts drying up, okay, once the banks stop lending, once the banks are taking their money out of the market, then you can look to sell. Then you can become bearish. But for me, it's ridiculous how, every second week somebody says market is going to crash this week, and they just get, a lot of attention or a lot of clicks on YouTube because ultimately, if you warn people about a crash, you sound smart. Nobody sounds smart or good when they say the market's going to go up because you just look naive. You just look stupid. Everybody looks at you like, how can you say that? Like, are you not informed? Like, do you not know anything? Look at this bubble that we're in. All that whole rhetoric. But if you say that things are going to crash, it's like you care, and you're warning people. So, anyways, I would just, blanketly, I would stop clicking on those videos. I think those videos, they don't know anything. They don't know anything, and do your own research. And for me, I look at the liquidity indicators. I look at that data is put out by the Fed, so you can look at that, and they do great research. And if you actually break down what the how they're doing their liquidity calculation, it actually becomes very apparent that the models that they're building are very robust. I tried to make my own liquidity thing, and I realized this is how do you even quantify the liquidity that the banks are providing? This is like it's pretty like not many people know, and people can come out on CNBC and say, oh, there's ample liquidity, but what do they mean by that? What do they mean by that? So it's kind of a tough thing to measure, but the Fed has they use multiple different data sources, which I will again link to and show you guys, and that's how they come up with their liquidity proxy. Anyways, that's it. Hope you guys have a great weekend, and I'll see you guys next time. Okay, so this is what I was talking about, the National Financial Conditions Index. This is made by the Fed. When the liquidity is getting worse, we can see that starts to go above zero. And again, when liquidity is improving, this starts to head down. And as you can see lately, this is just consistently going lower and lower. So what that means is that there's increased liquidity in the market. Liquidity is not drying up. So this is just a number, right? So this is just a calculation, but they need to arrive at it somehow. And this is how they arrive at it. There's all these different indicators, and they have different weightings. So they'll use like Bank of America, 3 to 5 year AAA, the mortgage spread. So a lot of these are spreads. And this is all used to determine what the liquidity in the market is. Usually, when the TED spread widens, it means that there is less liquidity. So people aren't as trusting. The banks are holding onto their cash, and they're not lending it. And this will spread, and it'll be reflected in the NAFC score. But this the U.S. bank card credit 3 months delinquency rates. So it'll take the home equity loans to total loans. A lot of different things. They use options markets to calculate it. Mortgage-backed security issuances. They use the GDP values. So it's pretty complicated.